traders, and welcome to Stop Loss Hunting Part 2. In today's video, we're going to be going over the price prediction challenge, recap of Part 1, and two new price formations that we can notice with the dual use of convincing retail traders to act a certain way and also hitting their stop losses. All right, so let's get right into it. So to begin, this week's price prediction will be on Litecoin for Bitfinex, and using solely Elliott wave theory, what is your prediction for the price of Litecoin by this Friday? So all you have to do is just join the Discord if you haven't already, and type in GameBot with in the private message section of Discord, and simply just submit your chart. So a screenshot of your chart, the price that you believe that Litecoin is going to get to by Friday at 1 p.m. Eastern, and a custom message that'll accompany it as well. If you want to give a shout out to your girlfriend, mom, or dad, or whoever, you can go ahead and do that. So yeah. Okay, so to recap from where we left off on the 32-minute part 1 video, what we are trying to do here is to trade against the retail traders, and not only try to trade where their stop losses are being hit, but also noticing when retail traders are being convinced that the market's going to move a certain way so that the market can move the other way. Why does this occur? Well, the reason that this occurs is because institutions need liquidity, and very, very high amounts of liquidity, because they're trading with a lot of volume and they're trading with a lot of Bitcoin. So where do they find high liquidity? Well, liquidity pools are typically located where many retail traders' stop losses are, typically right beyond support, right below support, and right above resistance. And if we place limit orders by this area, then we can ensure that there's likely going to be a heavy amount of market buying or selling, providing liquidity for us retail traders, even to have our orders filled by other retail traders exiting their positions at a loss. So the last thing that this does as well with price making these kinds of moves that we're going to be talking about later today is it convinces retail traders of a certain direction, and it convinces retail traders to act, to panic, or to get greedy and buy. And what this is going to do is just not just stop losses, but this is going to fill a lot of liquidity with types of markets that go down. And then as they begin to climb up, you still begin to see heavy market selling by retail, because they still believe that the market's going to go down, but then the market just continues to go up as the institutions are just getting their bids, also known as limit buy orders, filled at prices as price begins to move up. So we're going to be talking about a little bit of recap before we do that. So there are 3-point stop loss reversals and 4-point stop loss continuations. So this is all the schematics in this video are schematics that were drawn by me. So this first one here, we have an uptrend. We get H1 and then we get L1, H2. At H1 is typically known as the buying climax. This is where many traders are going to be buying into. And then we get this first initial low. For many retail traders, this might look like beginning of a spot to either take profit from my long or begin to short. And then as they do this, they get scared when this happens. A quick run up happens. Some of them may begin to exit their short positions or even enter long. And then when this occurs right here, this is when H2 breaks above H1, this is going to hit many short stop losses, which are going to activate as buying market orders. What also this is going to do is force many retail traders to act, because if they see strong momentum to the upside, and many other traders who are hitting the market buy button, then due to just the unconscious way that retail traders, all around of conformity, and the emotions that accompany conformity, like being very greed, many retail traders seeing the same picture, which makes them think similar thoughts. This is going to have a lot of market buying here, and then that's going to push the price down, because on the other side of that trade, institutions get to put their limit sell orders, also known as offers. They get to put their offers up here and sell at a fantastic price to press the price down. Opposite for downtrend turning into an uptrend with a 3-point stop loss reversal. Any traders who might have gone long here, who are trying to trade a reversal, are going to get stopped out here before the market moves up. 4-point stop loss continuations. So this occurs when the market goes up and then retail traders try to trade a reversal, but then to their shock, the market just continues to go up, and then they still believe that this is just going to reverse. So the really interesting thing here that occurs is many retail traders typically will market buy H1 and H2, and many retail traders will typically short L1 and L2 because they see high momentum and high volume to the downside, and many other traders who are shorting or buying as well. So when this occurs, this actually acts as a way of trapping many retail traders in short positions and stopping out many long traders, many retail traders who went long. And by doing this, this is just going to provide a lot of market selling liquidity for institutions to accumulate enough positions to press the price up, so that they can make money, so that retail can lose money. So what happens here is retail traders who might market buy here and then see this type of formation, um, they haven't sold already by panicking with this quick down move here, as the end of L1 and end of L2 are typically quite violent with low tails, as many stop losses get hit. Then they see this, and then they might hold their position and put their stop loss right below L1. And then when the second low happens, low 2, this is typically when many retail traders' longs are going to get stopped out. Shorts are going to begin to accumulate positions. Retail shorts are going to begin to enter positions to try to short this market. And retail is just overall going to be convinced that the market's got to move lower. It made a lower high and it made a lower low. And then they begin to market sell, even as price goes up. And we can actually see evidence of that. And then, to their horror, the price goes up. Yep. And just the opposite for a downtrend. So downtrend, we get the same kind of formation, just convincing retail traders that the market's going to go up and the market goes down. So this is just, these kinds of 4-point stop loss formations are a really good way to trade against the retail traders who are trying to trade against the trend. I love that little tongue twister there of trading against traders who are trying to trade the reversal. It's got a good ring to it. Okay, so now let's talk about the two new kinds of formations that we're going to be going over today. One of them is probably not new to, I would say, 80% of the viewers here, which is contracting stop loss formations, also known as just pennants or symmetrical triangles. So I don't want to just talk about this pennant or symmetrical triangle in its simplest sense, because that probably wouldn't be too helpful, just be repetition for what I've talked about and what gazillions of other instructors have talked about as well. So I want to talk about the psychology and dynamics of what's occurring with this range contraction. So this actually isn't hitting many retail traders' stop losses, as you can see here. We're not really moving beyond resistance, and we're not really moving beyond support. So what this is known as the retail take profit stage. This is where retail begins to exit positions, but not surprisingly, when retail begins to exit, that's when institutions begin to enter on the other side of the trade. So if retail, when the market goes up and then makes this kind of formation, many retail traders might believe that this is a reversal, just like what we looked at for the 4-point continuation pattern. Many retail traders might begin to market sell here, and from H1 to L1, and then H2 to L2, and H3 to L3. These are just going to offer spots for retail just to begin to market sell. And then eventually you get to a point of very low volatility and very low volume, as is with this kind of chart pattern. And then at this point, when the price just really isn't moving much because retail has already acted, that's when the market just picks up and goes upward. So this is typically where the retail traders are convinced of a market reversal. So just as I had said, shorts begin to accumulate, retail shorts accumulate, and longs begin to distribute. So longs exit, shorts enter, and they position themselves for reversal. But then they fill the orders of the institutions and they press price upward. So, yep. So this is just a simple one. I'm not going to spend too much time on this because the second formation is the much more important formation than this one, which isn't particularly new. However, I will say that this type of pennant, symmetrical triangle, or contraction range will happen either with 4 points, 5 points, or 6. So here you could even argue that this is like 6. 1, 2, 3, 4, 5, 6. I put it as 5 because of the trend line touches, and even though this one did touch. But the number really doesn't matter. The labeling doesn't matter. What's really important is understanding the shape of this market and understanding the psychology behind that shape. Because if you do that, then you can understand what retail is doing, and you can understand what institutions and market makers are doing, and then you can just position yourself accordingly and hopefully take profit at a better price. So this is just a classic example of what that kind of pattern is going to look like. Previous trend, continuation of the trend. Same with the downtrend. Previous trend, we have a smaller one here. So we have an L1, H1, L1, L2, H2. We see another 4-point here. Another just 4-point contraction period, and then the price goes down. As you can see, down, consolidation, down, consolidation, trading range, down. So, okay, that's definitely the much less interesting or new topic, but let's get into expanding stop loss formations. So these kinds of stop loss formations are meant to do two things. They're meant to confuse retail traders because we break a high and we break a low as well. And then also it's meant to double stop loss hunt these traders as well. So traders who are positioned in the correct direction, so traders in this example, let's say the market was going up. Traders who might have wanted to go long here before the market went up, what's going to happen is that institutions may manipulate with spoofing or large market and sell orders, or even bid walls and offer walls that are legitimate to make certain price formations occur so that certain stop loss clusters can be hit. And you can see that here at H2 and L2. These 2 points are where many stop losses are typically going to be hit. And then longs might mass exit here to cause liquidity for price to go up. And then also, that's the stop loss nature of it, but the psychological nature of it is confusion, where retail will probably just not know in the slightest what's happening here. Because we make a higher high, but then we make a lower low, and then price goes back in the range. I mean, I don't know too many chart patterns that look like this, except if we're talking like a head and shoulders, but this isn't exactly a head and shoulders because it doesn't always break down here. Sometimes it actually just continues breaking upward. So we can't call it a head and shoulders even. So that's going to confuse many retail traders. Let's look at some examples of this and get into how we can distinguish this and how we can distinguish which way the market's going to move. So the most important part of this kind of expansion formation, as I call it, the expanding, range expansion. With a range expansion, the most important part is to identify the buying or selling climaxes. So you have to ask yourself, is retail mass buying the market top, or is retail mass selling the market bottom? Well, let's look here. H1 has a good deal of market buying, has a good deal of transactions. As you can see here, this just represents volume, transactions. L1 has very, very few. We don't really see a lot of volume being transacted here. H2 has a behemoth of a lot of transactions occurring here. This could indicate that many shorts are getting stopped out and that many longs may be retail buying. And then we get L2 that is just really not occurring on any volume. And then we get a run up within the trading range up to here, but we don't really see any volume of that move or any transactions occurring. So this is a spot where the market's trapping many longs at H2 and trapping many longs at H1. And the only way that I figured that out was because of volume. Without volume, this pattern by itself wouldn't really be that helpful because it could mean a lot of things. But what volume is adding to it, to this formation, is showing us where the retail traders likely panic bought. And we can see that not many of them panic sold or panic short. Because if they did, and this is my evidence for that, if they did, we would be seeing higher momentum. We would probably be seeing some low tails as well. We see a high tail, really not many tails here either. So with this, you can see that. And the market went down because we trapped many retail traders here, filled the liquidity of institutions, and that's going to press price downward. So one thing I will say, because I know that this might seem a little bit contradictory, I've gotten many questions on this kind of stop loss theory of how can I distinguish between different kinds of formations, because different formations lead to different outcomes. This might initially actually look like a 3-point reversal with a H1, L1, H2, and then this looks like the downtrend of the 3-point reversal. Here's the first distinguishing factor, if you're ever curious. If you get a 3-point reversal with H1, L1, H2, price cannot move above L1. If it does, if price closes above L1 as it did here, then that is not a 3-point reversal. It's a different kind of formation. Okay, and then if you might be wondering, well, is this kind of like a 4-point formation with like a L1, H1, L2, H2 with like this going to here and this going to here? Not really. I wouldn't really count it that way because this higher high is quite important. But this is just certain ways that if you just backtest or if you just use the bar replay bar, that's what I use a lot, as you can see here, to go to replay mode and just look at some of these formations. I would say that you can begin to just breach that. The hardest part of reading these formations is distinguishing them from the other formations. And if you can use volume and price action, then you can begin to do that. But just the rules are quite important that L2 cannot close above L1 in a 3-point reversal and stuff like that. Okay, let's move on. So this actually formation looks very, very similar to the one before. It is a different formation, as you can see here. But we do have similar patterns. I see a good amount of buying, a good amount of transactions occurring on this run-up, and a good amount of transactions occurring at this top. And then what I see here is this candlestick was actually the very top price of H2, which means that many transactions occurred. So why do I say that many transactions lead to trapping traders and hitting many stop losses? Well, if we want to position ourselves in a certain market direction, we want to know that institutions have either accumulated enough or distributed enough of their positions so that we're not going to get another stop loss hunt that actually hits us and stops us out. And to do that, what you want to look for is very high volume at market tops if you want to sell, and very, very high volume at market bottoms if you want to buy. So I don't really see high volume at L1. I see no volume at L2, meaning that I'm not really seeing a lot of panic selling here. I'm not really seeing a lot of panic selling here. I'm seeing frantic buying here, as you can see, with a triple moving average volume candle, and frantic buying here as well. And this is just going to fill the offers of institutions so that they can sell at good prices and press the price down. And the final component of the expansion of range expansion with the double stop loss hunt here and here, is the final move back into the trading range that has to occur. This move, if this move has very high volume, then I would actually expect the market to move higher. But at the same time, you don't want H2 and H1 to have a lot of volume because that typically pushes the price down, because retail traders who buy here might actually want to sell here because they're selling at break even, which could cause a barrier for price to go upward for that good amount of limit sell orders around here. I'm just trying to get out at not a loss. But yeah, those kind of dynamics just push the price down, as you can see here. And interesting enough, I do see another pattern that we've talked about. This is one of the patterns from part 1 on this downtrend. And I'm going to give you guys 5 seconds to try to see if you can spot it before I label it. Okay, so I see a 4-point stop loss continuation. We get L1, H1, L2, H2. It checks out because when we draw L1 to H1, this is the 61.8 retracement, which should be as it is with L2. And then we get H2 that goes a little bit above. And this is just the continuation pattern of a downtrend, with the purpose being of trapping retail longs who are trying to market buy here and convincing the market that the market looks like it's reversing before we can push the price back down. Okay, let's look at another example here. So here we see expansion. We see the market moving down in a downtrend. And then we see a higher high, slightly higher high, and then we see a slightly lower low. So with this kind of formation, what I see is actually really not much volume at the market top. I see a good amount of volume being transacted at L2 and a good amount of volume being transacted at L1, none at H1, really only a little bit at H2 with this one spike, but beyond that, really not much. So what does this tell me? Well, this tells me that L2 might have been a spring, as you can see evidenced by a low tail in high volume, that could have stopped out many long traders who are trying to position themselves, giving their positions to institutions who, as those retail longs are market selling, because that's what a stop loss does, they're market selling to institutions to fill their liquidity. So I'm biased here to say that's going to go up, and it does here, as you can see. But it's important to just look at these individual factors, especially tails and volume. Low tail, higher volume here than here, higher volume here than here, very high volume here in the low tail, and price goes up in this range of expansion. Okay, so that was just looking at the first kind of expansion, which looks like this, with your initial being, H1, L1, H2, L2. But now let's look at the other kind with L1, H1, L2, H2. Same thing, just other way around, that's all. So here, I'm gonna see if you guys can spot it before I hit right arrow. Okay. So let's zoom in on this guy. I know I didn't give you guys like a ton of time with that one, but so here's what I see. We see initial high being made on really decently high volume. We see a good amount of transactions occurring here and a good amount of transactions occurring at L2 and then H2 here. So this type of formation is looking like to me that if I was to fit the puzzle pieces here, our institutions accumulating, our institutions distributing. This looks like accumulation. We have nice low tails here, high volume here, and really normal volume here. We also see decently good volume as the price makes the run up here. And the reason we want to see this decently high volume is actually because this is where many longs get stopped out. Shorts enter here, and many longs are getting stopped out here, especially. And after these guys get stopped out, we can position ourselves before the retail traders begin to position themselves according to the trend. Here would be to buy. So when we see these good amount of transactions, that's showing me that institutions are probably continuing to accumulate their positions on this run-up, and then price goes higher, yeah, as it does here. So one thing I wanted to show that's kind of interesting is if you zoom out to here, you can actually see a range contraction with a 4-point. H1, H2, L1, L2, right? H1, H2, L1, L2. And that's just giving more confidence that the previous trend is going to continue as it did here. Uptrend turning into consolidation, continuing the uptrend here. Then when we zoom in on the minute details here, you can see that we have a range expansion here with hitting some short stop losses, and as the price goes down here, shorts accumulate, and any longs who accumulate here, likely stop loss below here, get stopped out. Institutions get in, begin to accumulate their positions even more, and then you get this beautiful run up as the market demand gets quite high as it breaks these kinds of levels. Okay, so another just long video, but if you did last this long and if you actually watched the entire video, then that's a good sign. Because I know that watching like a 20 plus or like a half-hour plus video can be long, especially for YouTube. Yeah, but what we went over today is we went over two new kinds of stop loss formations. One's really not a stop loss formation, but more of just a way of convincing retail that the market's going to reverse and then just moving the other direction. And then we talked about expanding stop loss formations with really working to convince retail as well as hitting their stop losses. So these kinds of formations, the 3-point reversal, the 4-point continuation, the contraction, the expansion, all 4 of these cover all kinds of highs and lows being created. So we're really armed to analyze a trading range and really apply any of these formations to them. So yeah, so that's going to be it for this video, and have a good day.